What's going on, you guys? So in this video, I'm going to be going over stock options, and I'm going to be going over exactly what makes up a stock option, what are the different types of stock options out there for beginners, and then what are kind of all the different variables moving around that will determine your, say, overall risk reward, your expected reward possibly from an option. And I'm just gonna kind of go through this. I'm definitely not a, say, options expert, but I do occasionally use options. I think options are a great tool to, hedge your risk and really capitalize on unseen circumstances without having to risk that much capital. I know that I've talked about this a couple times on the channel, and a few people have asked me to do a video on options, and I'll definitely be doing more option videos in depth if you want in the future, but this one's just going to be an overview for people that have no idea what a stock option is, and they just kind of want to, dive, get their toes wet, and really see what's going on and see if options fit anywhere in their portfolio. Now, again, guys, I am not a financial advisor, and this is just all stuff that I've learned and I've read, and you guys need to fact check everything you do here on me and any other YouTuber you find on any financial topic out there. A lot of people say either aren't fully informed or they're just trying to sell you some snake oil. And anytime that you do a financial investment, you should definitely consider, educating yourself first and then talking to a financial advisor. So I just want to get that squared away before anybody thinks that this is just advice on how to use stock options. But this is what I personally do, and this is my interpretation of stock options. And I kind of just wanted to explain that in the basic form that I could possibly think of. So if you guys are into that and you want to learn about stock options, make sure to stick around, hit that like button, and make sure to subscribe. All right, so getting into it, what is a stock option? So taken directly from Investopedia, stock options are sold by one party to another that give the option buyer the right, but not the obligation. It's a big point there, not the obligation to buy or sell a stock at any agreed upon price within a certain time period. What essentially that means is that you are making a bet on a stock price, and you believe that it is either going to go up or down or have volatility within a shortened time, within a specific time frame, and you are willing to pay money to, say, win your bet, is essentially what's going on with options. Placing your bet is pretty much referred to as a contract. Now, a contract is a bundle of underlying securities that you get from your option. The majority of the ones that you will see on any publicly traded company are going to be in bundles of 100. And that's important to keep in mind when you look at the amount of money that you're actually going to be spending and the amount of money you could possibly be making, say, if your option executes the way that you planned on. So there are a lot of things that make up an option, but I wanted to go through the really important things that you definitely need to have down pat before you even think about, buying or selling options. And so first off is the premium. Now, the premium is essentially the cost of your overall option. So when you look at, say, a list of options going down and they're being bought and sold at different prices, when you see one, say, going for 10 cents, that essentially is 10 cents per share of the underlying asset. So when you look at a contract being a bundle of 100 shares, if you see the contract being sold for 10 cents, that means that you're actually going to be paying $10 because you're going to have to multiply that 10 cents by the 100 shares in order to buy the entire contract. The strike price is essentially the value that the option buyer has locked in, and they have the right to execute at any point in time as long as the option is still outstanding and it hasn't expired yet. Time value is essentially getting broken down into you can think about it, the longer that your option is going for, so you can get them that is, say, about a week, or you can get them, say, all the way up to 2 years. The longer the time frame that you have the right to execute your option in, generally the more expensive the contract is going to be. And that is you can think about it with time value of money. You can think about that a lot of different things can happen in the market during that time frame, and there's a lot less risk, say, for a long-term outlook versus a very short-term outlook, so things tend to be less volatile, and so people are more willing to, say, look 2 years out ahead rather than, say, what's going to be happening next week, because as we all know, stock prices in the very short term are extremely erratic, and it's really hard to exactly time what the price is going to be, so those get a much lower premium than, say, the ones that are going to be taking 2 years. And then volatility is also a big player when you buy a contract. And volatility, you can think about it, is essentially a company that has a beta of, say, 3 is going to have a much cheaper option contract than a company that says has a beta of 0.8. And now, without getting too complicated, I want to go over just the main basic options. And those pretty much boil down to call options and put options. Now, a call option you use whenever you believe in the company and you believe that the company is either undervalued or overvalued and you believe it's going up. And you can think of a call option as essentially the right to buy shares at whatever your strike price was, your locked-in price, at any point in time before the option expires. And in the opposite case, you have a put option. And the put option you use whenever you believe that a stock is either overvalued or believe it's going down within your certain designated time frame, and you have the right to sell the 100 shares that you bought per contract at any point in time during that option. Now, writing options is something that I do not believe that anybody that is watching a intro to options video will ever be doing, but if you ever want to, say, write options for stocks, you can either choose to write covered options, and those are options that are in relation to underlying assets or securities that you own or are currently shorting. So you can think about that if I own 100 shares of Apple, I can write out a call option and the right to sell my shares to someone else, and I only have to pay the difference, as opposed to an uncovered option is when you're making an option for a underlying asset and that you do not own those shares, so if it does not go your way, you have a lot of money you have to pay out. So definitely covered options are a much more safe option of the two, and an uncovered option is definitely the high risk, high reward type of scenario you're going for. And so now let's break down a very basic call option and just kind of do the math about what kind of returns you can expect to get from options and really what kind of an impact that'll have to your overall portfolio. So let's take this for example. If you have stock A, B, and C, and you believe it's currently undervalued and it's trading at $10 a share, you buy a call option with a cost of 50 cents that can be executed within 6 months. So taking a look at what I just said, you have your strike price at $10 a share because that is the value that it was trading at when you bought the option. You are locking that in with your option because you believe it is undervalued and you believe it will go above it. And you have the right to buy 100 shares of A, B, and C company at $10 at any point in time within the next 6 months. The premium you're paying is going to be the 50 cents times 100, so you essentially just paid $50 to execute that strike price at any point in time during the next 6 months. And let's see what happens assuming the share price goes up. So if the share price goes up to, say, $13 in 2 months, so this means that the underlying asset went up 30%, you now are going to be getting the difference between your strike price premium and the amount of money that was grown from those underlying shares. And so you can think about that as you say, take the $13 that it is currently trading at, the $10 that you paid for for your lock-in price. So you're essentially gaining $3 a share, and you paid 50 cents for the contract, or 50 cents per share. So you can pretty much look at for every single share that went up, you now made $2.50. So in total, you just made $250. Assuming that underlying asset went up $30, you just made $250 off of $50. And now, so was it worth it? So let's do out some math and look at the situation, what happened. So from the contract, you paid $50, that was your premium, and you made $250. That was after the premium, what your strike price was, and then what the underlying shares were worth and what you could sell the contract for. And so you essentially made 400% off of a $50 investment because your option went in the money and you were able to make, say, your return. Now, if you own the shares in this exact same scenario, you would have had to invest $1,000 in the company. And if it, say, went up 30%, you would have $13 in stock equity. And your total risk, however, is $1,000 because at any point in time, a company could go bankrupt. Things could happen, and that's just the risk that comes with investing. Obviously, and I explained down here that more realistic scenario would be that, say, the company went down 10% during that 2-month time frame. And you, on paper, have now lost $100 instead of the total risk that you were taking with the option, and that was at $50. Because with an option, again, you only have the right to execute it. You do not have the obligation to execute it at any point in time. So that means that if you buy, say, an option if you buy a call option and the company gets cut in half overnight, you will not lose any extra money, and you have now protected yourself from all of that downside while you are still allowing yourself to gain any of the possible upside potential from that option trade. And so that is my basic example of what options are and exactly what you can profit from it, and then how you can lose money in an option. And you can kind of, play around with the numbers and really figure out, okay, if I'm debating between buying shares of company X or if I'm thinking about buying an option in it, what do I want to do and exactly what does that do for my risk-reward profile? So if you guys want, I can definitely do a in-depth video on different option, say, strategies. Again, I'm not an option expert, but I do use some options in order to, say, capitalize on black swan events. Companies that I know are going to be experiencing major volatility, I generally buy options on, because then whether it swings up or it swings down, I'll make some money off of it. And that kind of all comes with different risks within themselves, but I definitely think that options are a great tool to be used. I personally am not someone who heavily uses options. I only use about 5 to 10% of my portfolio at any point in time in options. But for those of you that wanted to learn about options, there you are. And the majority of this information can be found on websites like Investopedia and other stock market related websites. And you can also learn about them in different books. There are many other YouTube videos here on YouTube that really go in depth with options. That's just kind of my explanation and kind of me dumbing it down as much as I can to really understand options and just kind of get your feet wet from here on out. So hope you guys liked the video. Hope you guys learned something. If you guys want me to go over any other option type things, just make sure to let me know in the comment section down below. There are a couple of strategies that you can definitely look at, or if you say are looking for that black swan event, options are definitely a great way to kind of capitalize on it without risking that much. And so hope you guys liked the video, and I'll catch you guys in the next one. Peace.